This JTS Mortgage Minute is brought to you by JTS & Company Mortgage Professionals.
Hey, good morning. I'm Jeff Farnham. Mortgage rates have been volatile in 2022. Most of that volatility has played out in the form of higher rates. The past 3 weeks have been a notable exception. To understand why this is happening, we first need to consider that higher inflation means higher rates. It was easy to forget that for most of the past decade, but impossible to escape since early 2021 and especially since early 2022. Several big jumps in inflation have forced the Federal Reserve to drastically tighten policy. One of those policies has been to buy lots of bonds, including those that specifically underlie the mortgage market. More bond buying demand equals lower interest rates. As the Fed backs out, rates are hit with a double whammy of high inflation and less buying demand. The resulting surge had covered enough ground by early May that it was time to consider the possibility that they had topped out indefinitely. That may have been proven to be the case were it not for a duo of hotter than expected inflation reports in the EU and the US. The latter, the Consumer Price Index, or CPI, was particularly troubling. It happened on June 10th and was responsible for the rapid spike up in 30-year fixed rates up into the sixes. Fast forward 3 weeks and rates are just now back to the level seen on June 10th. So why have rates dropped so much in the past few weeks? First off, they probably rose a bit too aggressively in mid-June. Traders were nervous as they waited to see how the Fed would respond to the June 10th CPI report, which didn't come out until June 15th. After that, it's possibly as simple as saying a majority of the economic data at home and abroad sent the signals we were hoping to see before the last month's inflation surprise. This most hotly anticipated example was the PCE inflation data, which along with CPI is one of two major inflation indices in the U.S. Although it was only slightly cooler than expected, this is all the market needed to continue the healing process. PCE also showed the third consecutive month of declines. The notion of a healing process for rates is bittersweet as it draws strength from damage to the global economy. One of the most basic ways to follow general economic trends is via Purchasing Managers Index or the PMI data. These are typically divided into manufacturing and non-manufacturing. They're far more timely than GDP data, so markets are more willing to respond. Most of the PMI data in Europe and US has been slipping recently with some notable milestones. One of the components of the Eurozone report showed the first decline in manufacturing output in more than 2 years. The US version painted a similar picture via the contraction in new orders, which plunged well into 2-year lows, matching the weakest pre-pandemic levels going back to the financial crisis. The combination of weaker economic data, cooler inflation, and an apparently overdone rate spike back in June means it's once again time to entertain whether or not we have seen the top in rates for 2022. In other words, have we seen a ceiling with mortgage rates? We wouldn't expect rates to be able to plummet until several months of data confirm a return to historically normal levels of inflation. As far as a ceiling, the bond market is certainly considering it. In fact, it's actively making that bet. So if you're looking into purchasing a home, to refinance, to lower your rate or reduce the term, consolidate debt or renovate your existing home, we are experts at matching you with a mortgage that best meets your needs. We look forward to speaking with you and helping you achieve your goals. At JTS & Company, we are home loan advisors located right here in your communities. We want to be your lifetime mortgage advisor. You can visit our website to get pre-qualified today or give us a call. We are local, trusted, and experienced. Thank you for joining me today and be sure to tune in next week.
This JTS Mortgage Minute is brought to you by JTS & Company Mortgage Professionals.